Alrighty, hi everybody. My name is Erken. I'm very happy to be here. I'm truly passionate about startups and technology, and luckily I get to work at the intersection of the two on a daily basis. Today I'll be sharing some thoughts on how to invest in crypto projects with you. I'm one of the founding. Does that work? So ideally, we jump to the next slide now. I'm one of the founding partners of Sunfish Partners. We're in the early stage VC that invests in deep tech startups right here in Poland. Blockchain is one of the industries that we're focused on. Personally, I've been in the crypto space since 2015. And over the years made a number of investments along all the different ways you can invest in the crypto space, from equity investments to token direct investments to convertible notes to directly buying tokens and some indirect forms as in terms of mining and staking tokens. Quick disclaimer before we get started, this presentation is not intended as investment, tax, or legal advice, and it really only contains my personal opinion. As a matter of fact, I'm trying to raise a lot more questions than give answers in this presentation, because I think that's going to be a lot more helpful for you guys. There are two kinds of people who lose money: those who know nothing and those who know everything. And by starting out, I just want to emphasize how new crypto is. And crypto is so new on very many fronts, right? It's new on a tech front, on a marketing front, on a legal front, on a societal front. So it's really impossible at this point in time to know it all. And what you're hearing today is a snapshot from really today. And if we all meet back in half a year, let alone 5 years, a lot of this stuff will have changed. The good thing, though, is like if you approach crypto very humbly and keep on learning, then you will be able to deal with all the uncertainties. And that's the special thing about this, right? So we have a large number of uncertainties. But even more daunting, we have a large number of uncertainties, and really embracing this can offer big opportunities. Starting out, you want to know what you really are investing in, right? And there's not a agreed upon definition of what different tokens are. The one I like and that I'm currently using is from Fabric Ventures, and they broadly categorize crypto projects in three classes. We have currencies and commodities, we have utility tokens and security tokens, and all three classes have subclasses, which yet might have more subclasses. So what's the big picture here? Token is not token, right? There are very, very big differences in terms of the legal background, in terms of the underlying business model, right? And in some of these cases, we're not even sure yet what the business model might be, or if and how they will eventually capture value, right? So you really want to get a good look at what you are investing in and for what reasons, and form your own hypotheses how this specific subclass of a subclass might capture value in the future. You also want to know how you will be investing in a project, right? There's a lot of different ways, and all of them have very different implications, right? I listed a couple here. So you could directly buy tokens on exchanges, or participate in an initial coin offering, or most recently they have been many initial exchange offerings. You could be doing a SAFT, which stands for Simple Agreement for Future Tokens, similar to a SAFE, same for equity, which is a convertible note, or equity, and there's many other forms. Important here, you want to be asking a couple key questions, because they differ, right? Again, there's no good or bad, there's just different attributes, right? Control is one thing, right? If you're an equity investor in a project, you might be able to exercise a lot more control than if you're buying tokens on an exchange and only have a tiny fraction of the outstanding supply. That's one example. You want to think about liquidity, and this might be important or not important for you, right? Could you sell your position tomorrow, or will you be locked up and could ideally sell in the next round or at the exit of the company, right? A lot of implications. Also think how this liquidity might impact you. Like, how will you be impacted by price swings that you can monitor on a daily basis. Think one level deeper. How will your founders be impacted with a project where theoretically they could sell tokens tomorrow, right? How would this have to be implemented with vesting schedules, with liquidation preferences and so forth? How is this going to influence them on getting and retaining key employees if all of a sudden the market is way more liquid than it would be in a regular startup investment? So again, a lot of questions here you want to consider. Yeah, one trend I mentioned, there has been a sharp decline in ICOs, which initial coin offerings again, which sort of like had their big time in 2017-18, but there's been a lot more legal pressure on doing this form of offering tokens. Investors have gotten a lot more cautious. The market has shifted a bit. So right now, this trend has sort of like ebbed to about $200 million per month for all projects raised. One question I think that's super important, and that certainly we ask and talk at length about with every founder that's talking to us is, does this project even need a token, right? Because we want to make sure we don't invest in something where someone just uses tokens as a marketing stand, right? Because I mean, it's hard enough to build a startup, and you don't have to make it overly complex by adding yet another risky technology to it, unless there's a clear need for this. And here's a crypto manifesto from Mike Golden, which I think is helpful to start you with your guiding questions. And first one is the token really has to be a necessary element. The system has to be self-sustaining, at least in the long term. And this is ironic, because this one means that if a great founding team is pitching a product, what they're really pitching is saying, okay, right now, maybe this team needs us, but eventually this project is going to work 100%, even if I die tomorrow or if I stop working on this, which is quite different from how you would approach startup investing, right? Again, one thing to think about, and finally, is this becoming a public utility. And obviously, you want to consider that a lot of eventually decentralized products still do start out with a certain degree of centralization at first, and there's trade-offs. Mining 2.0, that's a coin that was phrased by Notation Capital, and it's just interesting because it says, I mean, how is the role of investors in that space gonna change, right? Because I mean, right now, the classic VC model is you give a startup some money and get some equity, and maybe you add a couple services on top, you help them a bit with marketing and HR and finance. But now, in this ecosystem, there's a lot more stuff coming up that we could all be potentially doing. And some might make sense, others might not. Some stuff will change in the future. Just going to read this quote to you. What should become miners, stakers, validators, bonders, curators, dispute resolvers, nodes, hubs, watchers, routers for networks. So a lot of fancy words here, but in general, sort of like really think deep about the role of investors going forward to help grow ecosystems, to help secure ecosystems, to test ecosystems. And obviously, this could also present potentially new opportunities for those investors to make money, right? Because some of these functions, like staking tokens to secure a network, will also be rewarded. So this could mean another form of earning interest for investors. Or put differently, those investors who don't at least think about this might be losing out to other investors who do this. And even going one step further, there might even be projects where you as an investor won't even have access by just making a regular investment, right? Because the project is going to launch, and unless you're mining yourself, you won't have access to that project. So a question I've been wondering about, and I'm very happy that Fred Wilson published a good answer on this, sort of like how technical will investors have to get in the future to be relevant in that space, and I'm going to read it to you. He said, the good news for investors is that there's a whole bunch of entrepreneurs to help us do these things without each and every one of us becoming super technical. We'll see and are seeing staking as a service, nodes as a service, and the likes, right? So to add to my last slide, so maybe the answer isn't like doing everything yourself, but being aware of what you can do yourself, what you can use other services for. A couple recent examples, I mean, Coinbase, Ledger, and the like are really thinking about custody from an institutional standpoint. I mean, there's a whole economy evolving around staking solutions for Tezos, for instance, where you can earn interest by participating and staking your tokens and voting on things which you might not be large enough as a single investor or technically able to do, but then you can outsource this to someone else who gets a cut from your potential rewards. One thing that is important is to acknowledge that building a startup, which is already hard, is not the same as building a community, right? And building communities is very important in a crypto space, in particular if you look at the subsector of cryptocurrencies, right? Why is it not just a tech? Simple, because tech can be forked, right? In an open source world, someone can take your tech, fork that, and has an identical copy of the technology, right? That's why the community is so important. And you can most clearly see this with Bitcoin, right? I mean, Bitcoin has been forked more than 97 times. We're talking about the identical code base, yet still Bitcoin is valuable 10 times more than all the other forks combined, right? Because it has been able to build one hell of a community around that product. And here's just a couple things that can be very helpful in building a community. I'm using this from Nick. You want to have transparent, inclusive founding teams. You want to have distributed ownership and clearly aligned incentives. Distributed ownership is yet another thing where this is different from our traditional VC world, right? Where in most cases you want to have a very clean cap table with 2, 3, whatever, 4 investors, whereas a lot of crypto projects by design want to have as many and as diverse an investor base as possible from the beginning. You want to have a good meme like Bitcoin, digital gold, for instance, and you want to have or be able to create a useful tool that becomes a standard, sort of like Ethereum, which other projects can build on. One thing I just want to show you here. This is a scale of the chart of the Bitcoin price over time. And again, I'm not a short-term trader. I'm a long-term investor. So last thing I'm qualified to do here is give any chart reading techniques or something. And by the way, I think that's important too. Like understand where in the spectrum you are, because the skill set you'll need to succeed as a short-term trader is very different from the one you need as a long-term investor. One thing I just want to direct your attention to here is if you look at this road from 2013 to 2019, right, you see there's a lot of action in October 17 to April 18 going on. And you might get the impression, oh wow, Bitcoin, that was such a smooth ride all the way up until then, right? And that's the chart that the media will always show you, and it's a correct chart, right? It's a linear scale, and we tend to focus on linear scales. Important though, notice like we have this dip here in 13, 14 from $100 to $10, right? That looks tiny, and we have this dip from 20K to 5K, right, in 17, 18. That looks gigantic, but just keep in mind, one is a 10x, that looks like nothing here, and the other one is only 4x, that looks very big, right? So if we plot the same thing on a logarithmic scale, that's how this whole chart looks like. Again, exactly the same data, just a different scale. So what I'm trying to imply here, really get more data points, right? And in particular, in a complex topic like this, don't just rely on the mainstream media, but really think hard about stuff like this, because this, again, is exactly the same data. It looks quite different and tells quite a different story. One other thing that's interesting to look at, because it's one of many examples how the devil can really be in the detail. And those people who do the work, right, and go into these nitty-gritty details will have more data points to make better decisions, right? So here you have so I drew this data from Masari 2 days ago, who's building a really good site for you guys to look at data. And we're going to look at the blue circles first, right? Because crypto projects, they're not just tech experiments. In many cases, they're also economic experiments, right? And some projects have a constant supply, so the supply is already issued, whereas most projects have inflation programmed into their protocols, and some have deflation. And obviously, this has a lot of implications on your share relative in a network of how you're going to be diluted over the years, right? And we're just going to look at 2 examples here. So Bitcoin right now, 84.6% is already outstanding. That's 84, whereas for Stellar, only 13% is outstanding, right? And then we look at the 2050 market cap, so years in the future, right? And that's sort of like the difference, the reported market cap you have today and the 2050 market cap, right? And you see the big difference between the two. So all else being equal, Stellar will have to appreciate a lot more in price simply to beat inflation in the going years than Bitcoin, right? And again, I'm not saying this means one is a better investment than the other. It just means like you have to be a lot more bullish about the growth of one ecosystem, in this case, than about the other. Another thing that's interesting to look at is if you compare, we have the reported market cap again in the middle, and now we're looking at the green circles, and we have the liquid market cap, right? So how much of the market cap could actually be put on an exchange and be traded? Because in a lot of cases, there's going to be huge amounts locked up in code or locked up in legal contracts, right? And to compare this, in the case of Ethereum, that's about the same for what could be traded on exchanges and what's actually out there, whereas in the case of XRP, for instance, you have a delta of 5 billion right now. Again, not saying this is better or worse, just saying this has very different implications on how volume can move by the same amount of trades. So really take as many data points as you can. Yeah, and let's close with the billion-dollar question, or called the billion slotty question, sort of like what are good projects to look at, what are good projects to invest in, and again, I'm not gonna name projects here. I think it's way more helpful to sort of like share with you the framework I have for looking at this, and it was heavily influenced by Chris Dixon, and he sort of stresses that crypto is like a computer with a new capability, and by computer I really mean sort of like a new technology with a new capability. And that capability is trust. And you really want to ask the question, what can you do with that new capability, trust, that you can't do with the computers we currently have, the technology we currently have, right? Because it's very easy to dismiss crypto right now and say, well, this stuff doesn't scale, this stuff is slow. I agree with you. It's slow, right? But again, the interesting thing is here is not to ask, like, how is this going to make existing things better? It's to ask, okay, what can we do now that we couldn't have done before because of that trust element? And the thing is that we don't want to do is we don't want to make the same mistake that a lot of people did when back in the days a new computer came up, and that new computer were cell phones, right? And people said, oh, cell phones are shitty. My desktop computer is a lot faster, looks a lot prettier, has better resolution. Agreed. But the killer features of a cell phone were portability, right? You had a GPS integrated. You had a camera all of a sudden. And this, for the first time, made billion-dollar ecosystems and companies possible that weren't possible without this before. And that's the same question here. What billion-dollar companies will be built because for the first time in history, we can implement trust in technology. We do not need a middleman. That's it. You guys can reach out to me, Marcus at sunfish.vc. One of my co-founders, Max, is the gentleman taking a photo right there with the white pants. You can also reach out to him, and if you found this helpful, feel free to follow me on Twitter or LinkedIn, where I share my latest thoughts on technology. Thank you.
Thank you, Marcus. Perfectly on time.